But let's discuss something that fired up bank stocks, especially PSU bank stocks, or the large banks which are exposed to infrastructure companies yesterday. The announcement day before yesterday from the Reserve Bank giving them more teeth to be able to divest promoters from their ownership of companies where they are defaulting on the loans. The issue is likely to see some perhaps promoter changes, but let's ask people who are in the hot seat. Arun Kaul, the CMD of UCO Bank, is joining us. Mr. Kaul, with these new norms, are you going to see more promoters becoming proactive and being more cooperative for fear that they will lose control? How do you see, for example, asset sales, pick up in the months to come?
Well, it is certainly a very good enabler for the banks, and it would certainly deter the non-cooperative borrowers. It will be strong deterrence against them. And I'm sure borrowers will come around and cooperate with the banks so that the stress assets can be put to the right use.
So you see more companies exit the CDR successfully because of the fear of this SDR?
Yeah, it should happen. It should certainly happen.
Okay. Mr. Kaul, could there be apprehension by banks to take over 51% of the company on fear that it might be difficult to transfer the equity to a new promoter? Hence, banks will eventually be lapped with a bad asset?
You see, objective is very clear. Objective is to change the management. Objective is not for the banks to run the companies. So I think banks will be careful because banks can't run the companies. Will apparently change the management so they put the company to stronger hands who can help to turn around the company.
But sir, what if you can't find a promoter to take over the 51% or how much ever the banks will eventually own?
Well, we'll have to wait and see how it shapes up. We'll have to just wait for it.
Okay. Mr. Kaul, on the other hand, if there is a serious promoter who, despite serious efforts, can't stand by the debt obligation, assuming it's a promoter who's doing well, then what would the JLF do? What kind of flexibility does it have? Can it provide more loans or can it waive the SDR rules?
No, objective is very clear. Objective is to bring about change of management. If a particular management is not able to perform, and look for the new management. And that is what gives the enabling provision to the banks. They can do that.
How easy do you think is the process of conversion of loan to equity?
Well, that possibility cannot be ruled out. The RBI has very clearly said that all new application for the loans, banks must ensure in the documents itself there's an enabling provision for this is there. And I think all the new agreements, the companies will have to have the shareholder approval for this enabling provision, so that the later on legal problems could be avoided. And so the lenders are concerned, 75% lenders agree to this. That into the RBI guidelines, 75% by and 60% by amount. So this will be binding on others.
Okay. Do you think, sir, that this tool might have come a little too late and the incremental benefit might not be as much as, say, 1 year ago?
No, I would not say it's a bit too late, because last year in 2014 guidelines also RBI had indicated something like this, that banks can do convert into equity and something like that. It was already there, they indicated that time. Now with the SEBI clearance and all, I think it's a fairly strong deterrent for the willful defaulter and a good enabler in the hand of the bankers.
Okay. Will this strategic debt restructuring be applicable for 525 cases? Say an account has 525 applied to it. Can it also have an SDR clause?
Well, I think there was nothing which prohibits them. I mean, subject to the guidance RBI said, if you comply with that, I think there's nothing to prohibit that.
Okay, so you can impose this clause even if it is a refinancing and not a restructuring. Okay, which sectors are banks likely to apply this debt conversion into equity successfully? Do you see it happening in power, or do you see it happening in steel or in roads?
Well, I think it would be basically these sectors only, power, steel and infra only. That is where the major problems are coming up.
How many accounts or sectors do you have exposure to that might come under strategic debt restructuring? I mean, what amount of UCO Bank's money is involved where you may start imposing these clauses?
No, we'll have to work it out. I don't know the details. Right now, the data is not there with me. We'll have to work it out.
Okay. Given these new norms, sir, do you foresee better year for gross NPLs in FY16 as opposed to FY15?
Yeah, it should be. I mean, so far the UCO Bank is concerned, we think probably since we changed our entire strategy, so going forward, I think our NPLs should gradually come down, and this would certainly help us to further reduce them.
And what about Q1 FY16 in specific, sir? Will slippages be similar around the 2,000 crores that you did in Q3 and Q4?
No, it should be lower than that. It should be much less slippages.
Actually, you know, in Q1, will you see the kind of interest reversals that you saw in the previous quarter? If those interest reversals are less, do you think you will get a better net interest income? Last quarter, it fell by 18%.
Yeah, it should happen. We see some of the where UCO Bank is concerned, there's small growth in the credit, but we don't see much reversals because there's hardly any restructuring this quarter.
So overall, you know, you closed the year last year with 6.7% as gross NPLs. What may be the FY16 number?
Yes, certainly we do expect NPLs gross and net both to come down.
Okay. All right, then we'll leave it at that. Thank you very much, Mr. Kaul, for joining us.